All right, guys, in this video, we're going to talk about taxation of personal life insurance and annuities. So I want to start off kind of just talking about pre-tax and post-tax. If you get the basis of what I'm talking about, it's going to make a lot more sense when we get into the material. So pre-tax dollars means you work and you earn money. Let's say you earn $100. Before Uncle Sam takes taxes out, let's say you put $20 in your retirement. $100 minus 20 is $80. That means $80 is taxable. Because you put this 20 in pre-tax, Uncle Sam wants taxes when you retire and you go to take the money out. All right? So pre-tax examples are money that goes into your 401k. It's coming directly out of your paycheck, goes into your 401k. It is taxable when you go to retire and take it out. All right? So y'all get pre-tax. It means the money came out of your earnings before taxes. Let's talk about after-tax money. You're going to see this pre-tax money on qualified plans. You often see it on qualified plans. Talk about after-tax dollars. So let's say you made $100 and Uncle Sam taxes you 10%. 10% of 100 is $10. You take home $90. So taxes come out. Taxes leave your paycheck. $90 is your income. Then you put money into your retirement. So let's say I put the 20 into retirement. And that leaves me with $70. All right. This is after tax because you earned the money, you paid taxes, and now you're putting money away after taxes have been paid. So Uncle Sam says, oh, well, we won't tax you on this because you paid taxes on the money already. All right. And so an example of this you'll see is in a Roth IRA. When you put the money into your Roth after tax, when you leave that Roth account open 5 years or more, when you go to take the money out, you don't pay taxes. All right? So that's pre-tax, after tax. Anybody with earned income can put money into a retirement account. Okay? So let's say, and I'm making this up, but let's say the IRS limit this year is $2,500. And I'm making this up. But let's say the IRS limit this year is $2,500 in your retirement account. If you went and earned $2,550, you can put this whole $2,500 into your retirement account. So you can put money in up to the IRS limit. All right? But you have to have earned income to do it. So if the test asks you something like, Billy was unemployed all of 2019. How much money could he put in his retirement account? None. He didn't have earned income. Okay? All right. So let's talk about qualified plans. Qualified just means IRS approved. The IRS is going to give you favorable tax treatment because you followed certain guidelines. And I'm saying you as in corporation. Corporation who started the qualified plan, follow certain guidelines, and IRS says we like those. And we'll check a box saying the folks who participate can have favorable tax treatment, and you as a corporation can have favorable tax treatment. So let's talk about favorable tax treatment on the corporation side. When they put money into your retirement plan, they can take a tax deduction. All right, favorable tax treatment. When you put money into your retirement plan, you can take a tax deduction. Remember I showed you you're not paying taxes on that money. It's growing tax deferred, right? So those types of things, those are benefits of qualified plans. So here are some of the things that the plan has to have in order to qualify as qualified. So it has to be designed for the exclusive benefit of the employees. So it can't be designed for any other reason other than an employee benefit. And it can't cater toward any prohibited group. So it can't cater to shareholders. It can't be designed just for the benefit of high officers, high-ranking officers in the organization. It has to be formally written and communicated. So people in the organization need to know they can participate. It has to have a vesting requirement. Vesting requirement just means the amount of money that the company puts in your retirement account for you, that there's a certain schedule to when you get access to it. So maybe you work there for 2 years and you're fully vested. Or maybe, after the first 5 years, you get 40% of your money vested. So it has to have some formal vesting schedule. It has to be IRS approved, and it has to be permanent. So it can't just be something they did, something the corporation did just to get the tax advantage that year. It has to be permanent. All right, so contributions that you put into a qualified retirement plan are tax deductible. That means you deduct that dollar amount from your taxable income and you pay taxes on what's left. Okay? So let's talk about individual qualified plans. Two most common are the regular traditional IRA and the Roth IRA. Traditional IRA. So this allows you to make a tax deductible contribution until you reach age 72. So the Secure Act of 2019 changed it from the way that it used to be, where you could only be 70 and a half. Now it's 72. Plan participants contribute up to a certain dollar amount or 100% of their income if it doesn't exceed that dollar amount. So spouses can have IRAs too. As long as they don't exceed the limit, they can contribute. All right. So withdrawals on a traditional must begin by age 59 and a half. I'm sorry, they may begin. They don't have to by age 59 and a half, but you must start taking distributions at 70 and a half. All right. I'm sorry, y'all. I'm so used to saying 7 and a half. It's 72 now because of the Secure Act of 2019. And so that's your tradition. Now let's talk about Roth. Well, before we talk about Roths, let's talk about SEPs. So simplified employee pension. Those are available to your self-employed people. They're available to folks who have like small businesses, like maybe you have under 100 employees, you got like 3 to 5 employees, that kind of thing. Then you can get what's called a SEP. Usually you're going to see this with the independent person. So if I work for myself, maybe I'm a plumber or a contractor, I have a SEP. The thing to remember about a SEP is you can put up to 25% of your earned income into that account. Simple, that's another type of plan. So that's for businesses that have 100 employees or fewer. Simple, so that's what you want to remember about that one. Simple, 100 employees or fewer. And the company can put up to 3% of the employee's annual salary. Taxation is deferred on the contributions that the person puts in and the contributions that their job puts in. So taxation is deferred on that until withdrawal. With 401k plans. So profit sharing and 401k plans, those are in the same family. So 401k, this allows an employee to take a reduction in their current salary. So let's say my salary is $70,000 and I want to put 10% of my salary a year up. Then $7,000 every year is going to go up. So I'm taking a reduction in what I would currently take home. That is coming out pre-tax. So when I go to take my 401k out when I retire, I'm going to pay taxes on that at my current income tax level. So when I'm 65, I'm paying taxes at that tax bracket. Let's see. So 401ks can be organized in different ways. So a pure salary reduction plan, that's like I just talked about, you take some of your salary out. It could also be a bonus where your employer puts bonus money away for you, or a thrift plan. That's where your employer has like a defined benefit that they know that they're going to put up for every person. So they promise based on their profit how much they're going to give. 403B, that's another style. These are for nonprofits. So what I want you to remember about 403B, 501c. If the test talks about 501c3 organizations or nonprofit organizations, those are the folks that can qualify for 403B. So that is a tax sheltered annuity. You're going to see this with school teachers. That's a lot of times where you'll see 403B plans. School teachers, churches, places like that. So the maximum dollar amount changes every year that you can put up in a 403B. So it adjusts with inflation. Usually public school systems and stuff, that's where you'll see that. So let's talk about the taxation of a qualified plan. The employer contributions are tax deductible to the employer. So that means when they put money in your account, they take a tax deduction. When you put money in your account, you reduce your taxes that year too. And then you pay taxes later on when you go to take the money out. Lump sum distributions receive favorable tax treatment. And if you needed access to the money before 59 and a half, then you will pay a penalty unless you meet certain criteria. So death, disability, things like that. Distributions from the IRA can be made prior to 59 and a half. So that's one thing to remember. But don't forget that 10% tax penalty. Now the penalty is waived. Remember, I just said in most cases you're gonna pay the penalty. But let's say you are totally disabled, the penalty is gone. If you're using the money for education, the penalty is gone. If you're using the money to put down payment on a house as a first-time home buyer, the penalty is waived. So post-secondary education, the penalty is waived. So that's oftentimes catastrophic medical expenses, the penalty is waived. So that's why I still encourage my clients to utilize their 401k or their IRA, even though that's a qualified plan. A lot of people say, well, I don't want to pay the penalty if I ever need the money. If you need this money, it's because of something serious, and they're going to waive the penalty for that. You're not touching it for nothing else. If you're my client, I'm a fuss, okay? So also, if a judge orders during divorce, a judge can order the proceeds of the money that's in that retirement account be split. So that's something else that can happen. Now, let's say somebody passes away and they haven't taken the money out of their 401k yet or out of their retirement plan yet. By the 5th anniversary of their death on December 31st, so December 31st, on the 5th anniversary of their death, that is when the money has to be out of the account. So the beneficiary needs to take it out by then. Let's talk about Roth IRAs. So with Roth IRAs, contributions are not tax deductible. So you're putting after-tax money in, you're not taking your tax deduction that year. The money's still going to grow tax deferred. That means you're not paying on the money at that time. And then when you go to pull it out, if you've left that account open for 5 years or more, you are not paying taxes. All right, so legally, you don't have to. Excess contributions that you put in are taxed at 6%. Same thing with your traditional. So if you put extra money in your IRA beyond the limit, the IRS says we're going to tax you an additional 6% on that money. Because you're only supposed to save up to that limit. All right. So rollovers and transfers. Let's say, one thing to remember about the Roth IRA is that the distributions do not have to begin at 72. So you don't have to take those required minimum distributions on a Roth. You can wait until later in life to take those. Sorry about it. Rollovers. All right. So let's say you leave your job. You can take the money that's yours. You know, if your company says you're vested by 5 years and you've been working there 10 years, you can take that money too. You can take your money to your new retirement plan. So you leave a job, you can roll that money out. Let's talk about how rollovers work. So rollover is a tax-free distribution from one retirement plan to another. If the money rolls directly there, then it is a direct rollover. But if the money is given to you, then there may be a 20% withholding from it. Okay? So 20% of the distribution must be withheld. Mm-hmm.
So I had a friend of mine, like for us in the sheriff's office, they tax when you take it out, if you don't do the whole 30 years or you don't meet the age or whatever the requirements are, but then you get taxed again when you file.
Because then it's taxed as income. Mm-hmm. Yeah. So you got the penalty.
That's the penalty part that you pay it down.
And you have claim it as income.
Okay.
Yep. So transfer or a direct transfer. This is a tax-free transfer from one retirement account directly into another. So this could be going from one traditional IRA to another traditional IRA, where you're moving the money directly from one trustee to the other. So if I have it at Fidelity and I'm moving it to Primerica, right? So that electronic transfer directly over. Now let's talk about personal life insurance and how it relates to taxes. You remember we talked about pre-tax and after tax. Let's say I get my paycheck and my paycheck is $2,000. I get a paycheck for $2,000. I have already paid taxes by the time it comes to me as a paycheck. When I send off the $60 for my life insurance premium, I cannot write this off on my taxes. So this is not tax deductible. So your payment towards your personal life insurance is not tax deductible on personal life insurance. When businesses pay for the life insurance or their key employee policies, it is not tax deductible because that business is going to receive the proceeds from that policy tax-free. They take it as a lump sum, they're going to get the money tax-free. Okay? So when a business pays for, what's it called? That executive bonus type of policy, where they're paying the executive an additional salary, they're paying them extra money, and the employee takes that money and buys the life insurance that they want, the company can take a tax deduction for that because they're paying you extra salary. That is not their policy on you. That policy is for your family. They're just paying you additional salary. So that one is tax deductible. But the key person employee plan is not tax deductible. All right. Death benefits that are paid in installments, where the installment has some principal and some interest, that interest money is taxable. So anything beyond the premium paid, anything beyond that cost basis, that money is taxable. Dividends. When you receive dividends, remember mutual policies pay dividends. Those are what we call participating policies. So only mutual companies pay dividends. The types of policies are called participating policies because everyone with a policy participates in the growth of the company. If the board of directors declares a dividend, that money is paid to you. That's just a return of your unused premium. The government is not taxing that. That's your money being given back to you. They don't tax that. But if you leave the dividend money with the company to accumulate interest, that interest is new money. And so the IRS wants taxes on the new money. All right? So growth is always taxed. That's kind of an easy rule to remember. Policy loans. Remember, I can take a loan from my policy and do what I want with it. I can take a loan from my policy. If I have a policy that's cash value, I can take the loan from my policy and go on a vacation, buy a car, start a business. I can take a loan from my policy and do what I want with the money. I can put it down as collateral in the bank so that I can leverage it for something else. Whatever I want to do, it's my money. But policy loans are not income taxable. When I die, though, that money is subtracted from my death benefit. So accelerated benefits. So let's say I become terminally ill and I need to take an accelerated benefit. That means I, the insured, am terminally ill or need some type of expensive medical intervention, and I'm going to take a part of my policy out early. So I'm going to take a part of that death benefit out while I'm still alive. That money generally is received tax-free. So generally is received tax-free. So up to a certain limit, when I'm receiving those benefit payments, let's say I have Alzheimer's or some type of cancer where I'm going to get an income out of my policy, then in some cases you're going to see taxes on that. All right. And so any amount received in excess of that dollar amount is income taxable. So just remember that generally received tax-free. If it's like I'm going to take 40% of my policy out and go have a kidney transplant, generally free of taxes. If I'm receiving payments, terminally ill, and I'm getting payments over time, then you may see income taxes. Surrender value. So remember, if I have a whole life or universal life, it has built up some cash value. If I go to surrender my policy, that means I've given up my contract with the company and I'm just going to take my cash value. Generally, that money is not taxable because it's a return of my money. But anything extra beyond that, so if that money has earned interest, anything beyond the cost basis is taxable. All right. So let's say that the premium that I paid was $70,000, and my policy's face amount is $300,000. Total cash value that I have available is $100,000, and I want to take a loan out. All I paid is $70,000. The cash value I have available is $100,000. That means the other $30,000 came from somewhere. It came from that accumulation. Okay, so I'm going to pay income taxes on the last $30,000 that I borrowed. Does that make sense? All right. If the beneficiary receives the death benefit, that's called a settlement, right? So we have different options on how we receive the settlement. That's the big check in life insurance. I have different options on how I receive that money. If I receive it as a lump sum, it's not taxable. But if I receive it as like income that's paid over time that has some interest in it, that money is taxable. There's another time where you'll see the death benefit be taxable, and that's if it is paid to the estate. So let's say I don't name a beneficiary, and my life insurance death benefit is paid to my estate. It is federally taxable, right? So it's paid to my taxable estate. And then also if there are some incidences of ownership. So let's say I have sold my policy before I died. I gave my policy away to somebody within a few years before I died. That is called incidences of ownership, and then it is taxable. So it's within 3 years if I've transferred that ownership over. All right, now let's talk about if I'm trying to pimp my life insurance, right? So you'll see this sometimes on YouTube. There are these YouTube gurus that are telling people to overfund their life insurance and create their own at-home bank. I'm not a big fan of that idea, right? Here's why. We're going to talk about what the IRS does with that. So if the IRS notices that you are overfunding your policy, that means you're stuffing way more money into that policy than it takes to fund your death benefit. The IRS has instituted what is called the 7-pay test. That means if you put more money in the first 7 years of that policy than it would have taken to fund it, then now it is subject to taxes. It goes from being life insurance and having all the taxation benefits of life insurance to being a modified endowment contract. That's what a MEC is. So if it fails the 7-pay test, it becomes a MEC. With a modified endowment contract, it has lost those tax benefits. And so now if you want to take a distribution out or loan out, you're going to pay taxes on that. All right. Let's see. Any other thoughts on that? If I want to take a distribution out before I'm 59 and a half, I have a penalty. It's taxed on a last in, first out basis. So that means interest was the last to go into that account. It is the first to be taxed on the payments. All right. But it still accumulates tax deferred. All right. So any thoughts? Y'all good to go? Okay.